I think now is a particularly attractive time to be investing in UK equity income, given the scarcity of income from other investments and asset classes. But I think a bias towards equity income is always sensible, and there are a number of reasons for that. Firstly, numerous studies have demonstrated that dividends and their reinvestment generate a very significant proportion of total returns. Dividends act as a touchstone for the health and strength of a company, and I think the requirement to pay a dividend encourages management to act in a disciplined and responsible manner in terms of the long-term stewardship of a company. Well, I think we're very fortunate to be able to invest in a lot of very good quality companies in the UK with some very strong competitive advantages. And those competitive advantages might be intellectual property, such as patents or brands. They might be experience of operating abroad, particularly in faster growing emerging markets, or the ability to make use of some very skilled human capital. And I think in the UK as well, we have a very strong legal and corporate governance framework. And from a yield perspective, if you compare the UK to other regional equity markets, then the UK has a very appealing dividend yield, but also a very strong equity income culture. In terms of the portfolio construction for Murray Income, we normally have around about 45 holdings. Our aim is to build a sensibly diversified portfolio. We don't want to be hostage to any one economic scenario, and we don't like to have more than 5% of our capital in any one holding. What we want to do is populate the fund with good quality companies, companies with strong balance sheets, robust financial characteristics, very good competitive positions, and also that are attractively valued, the sorts of companies that can grow their earnings and their dividends over the long term. Looking at the positioning of the portfolio compared to the benchmark, which is the FTSE All-Share Index, we're overweight pharmaceuticals. We think that area of the market is very attractive, with companies using their R&D budgets much more efficiently. There are some exciting new areas opening up, such as immunotherapy, and companies can benefit from some very strong growth in emerging markets and also some long-term demographic drivers. We're underweight banks. We're concerned about the regulatory outlook, concerned about the opacity for investment banking revenues, and also concerned about the long-term growth prospects for a number of banks. And we're also underweight oil and gas producers, where we don't think it's right to replicate the relatively large index weight in the trust. As an investment trust, Murray Income benefits from an independent board to look after the interests of shareholders, and I think we're very fortunate to have a very strong board. Also, the trust has revenue reserves that allow it to smooth the flow of income to shareholders, and because it's an investment trust, it also can use gearing if we think that's appropriate to amplify returns. More generally, it has an attractive yield and it focuses on good quality companies. It has a very patient buy and hold investment approach. And over a number of years now, we've been able to generate a very consistent track record